Hello and welcome to this set of videos on Chapter 13 of Government in America, focusing on the budget. This should be two videos. So the budget and the legislation that creates it sets the framework for everything that a government does. Because if you can't spend money on a project, that project won't happen. If you want to have a strong military, you better pay for it. You want to inspect food to make sure that it's safe to eat, start cutting some checks. The budget is what allows the government to do any of that because it sets out how the government will collect money, called revenue, and what it'll spend that money on, which is called expenditures. When the government's revenues are greater than expenditures, the government has money left over after it pays all its bills. That's called a surplus. If the expenditures are greater than the revenue, then the government is running a deficit. There's a gap between what the government needs and what it has. The government's going to need to borrow money to fill this gap. The federal government raises most of its revenue through taxes. The rest of it comes through things like fees and tariffs on trade if you consider them separate from taxes. The largest share of the federal government's tax revenue comes from the federal income tax, which wasn't even allowed under the Constitution as originally ratified. Taxes had to be excise taxes, which were paid on specific items, such as today's gasoline tax, or like the alcohol tax that helped set off the Whiskey Rebellion. Or they had to be assessed on a strict per capita basis. But the 16th Amendment allowed for the establishment of an income tax that didn't have to be on a per capita basis, and now the federal government heavily relies on that income tax. Now, one feature of the federal income tax that's not shared by all income taxes is that the federal income tax is progressive. This means that the higher your income, the larger the percentage of your income that you will pay in taxes. It's all about the percentage. This is important, so indulge me for a second while I get pedantic. A progressive tax is not a tax where if you're rich, you pay more. An income tax where everyone pays 5% of their income would require a person who makes $1 million to pay more than someone who makes $10,000. But that would still be a flat tax because they're paying the same rate, the same percentage. They're both paying 5%. A progressive tax would require the person who makes $1 million to pay, for example, 20%, while the person who makes $10,000 only pays 4%. If the rate goes up, the more money that you make, that's a progressive tax. Pennsylvania, where I live, has a flat state income tax. It doesn't matter how much you make, you pay the same percentage to the state. Now, the federal income tax works through a series of ranges called tax brackets. Imagine it this way. The federal government takes your annual income and divides it into a set of piles. Now, my exact numbers here are a year or two out of date, but you'll get the idea. If you're single, the first pile would be the first $9,275 that you make. The government will take 10% out of that pile. Then the second pile is everything from $9,276 up to $37,650. The government will take 15% out of this pile. This goes on until the last pile would be everything you make over $415,501. And the government will take 39.6% out of this pile. It's a little complicated, but this way no one loses money because they got a small raise that pushes them into a higher tax bracket. They only pay the higher rate on the extra money that's in that higher range. Okay? Now again, there have been some changes to tax law since I looked up these numbers. So the exact percentages are a little bit different, but you get the idea of how a progressive tax works. Now, the United States does also tax business or corporate income, and the raw percentage that a company is supposed to pay is fairly high compared with many other countries. But corporations have different methods to lower their tax bills, so many pay much less than you'd think based on that sort of headline percentage. One of the big issues that people are arguing about, in Congress and throughout the country is whether United States corporations should pay taxes to the United States on money that they make in foreign countries. If Apple sells an iPhone in India, how much tax should they pay to the United States government? Because they're a United States company. is in many cases, companies will leave that money in the foreign subsidiaries or in the foreign country so that they don't have to pay the taxes that would be required to move the money back to the United States. Now, in addition to the income tax, many people also pay taxes to fund social insurance programs like Medicare and Social Security. Many of these taxes are based on income, and they're taken out of a paycheck, like the deductions for federal income tax. But these taxes are established by separate laws, and the rates for these taxes cannot be changed without modifying the law that established the program. In addition, while there are ways that you can lower what you owe for income tax by getting credits and deductions, it's very hard to lower what you owe in Medicaid or Social Security taxes. Those tend to be more straight, here's what you owe, this is what you got to pay. One more added detail, on some of those taxes for Medicare and Social Security, employers as well as employees pay a tax to the government. Those are called payroll taxes. Now, we are in a period in the United States where the money we raise from these taxes is less than what we have to spend on all of the programs that the government runs. So we are running a deficit, and the government must borrow money. That means that the government money that the government borrows plus its accumulated interest is the government's debt. During most of my lifetime, the federal government has run a deficit. So we've borrowed a fair amount of money. Now, there was a period in the late 90s where the government had a surplus, but it still had debt because of all the money that it had borrowed and was still paying back. But it didn't need to borrow anymore. That period ended around 2001, and we've been in deficits again ever since. Now, one thing that reduces government revenues is the extensive system of tax expenditures that Congress has passed over the years. Tax expenditures are a little accounting trick. All right, let's say the government wants more people to install solar panels on their houses. So the government wants to give people an incentive. Now, one way to incentivize people would be to give them money, but that would increase spending, and a lot of politicians don't want to be accused of raising spending. So instead, Congress can create a tax incentive, where if you install solar panels, you pay less in taxes. Now, whether the government gives you $100 or tells you to take $100 off of your tax bill, either way, the government has $100 less than it would have if it weren't trying to get you to put those solar panels on your roof. But with the tax break, the tax expenditure, Congressperson Jones doesn't have to worry about an opponent running ads saying, "Congressperson Jones supports wasteful spending." In fact, Congressperson Jones can even run an ad saying, "Vote for me, I helped cut your taxes." So Congress tends to like tax expenditures, even if they make the tax code a lot more complicated. So that's going to wrap up this video, this discussion of where the government's money comes from. Next video, we'll talk about where it goes. Until then, I leave you with these questions for further thought and discussion.